Right. Good evening, everybody, and welcome to this first, for a while, event looking at industry challenges, industry problems, new regulations that are coming out, and we are delighted for this event to welcome Palvinder and Anita. Palvinder, give us a wave, say hello.
Good evening, everyone.
And Anita.
Hi, everyone.
Hi. So
Hi.
Palvinder and Anita are experts in the field of operational resilience and the new regulations that are coming out. And they're going to take us through this evening a few slides that explain the background to operational resilience and regulations that are coming out. What we should be doing and how we should be preparing for it. And at the end, then we'll have time for some Q&A. I would ask you, everybody, if you've got some questions as they're going through their slides, put them in the chat and we can deal with them and work on them at the end of the session. But hey, listen, lovely to see you all. Thanks for joining, and I'm going to pass over now to Palvinder and Anita to take us through the next 20 minutes, half an hour. So, Palvinder, Anita, over to you, and thank you. Really looking forward to this.
Okay, just tell me when the slides are ready to go, Pal.
Okay, they should be up.
Okay, so we'll get started. First and foremost, thank you for joining us today on today's webinar, Building Operational Resilience, bringing together multiple disciplines. The UK regulators, so the Bank of England, PRA, and SDA, recently conducted a series of consultations that concluded on the 1st of October. And they're now starting to communicate feedback they received. Some of this feedback is summarized in the 6th of October Bank of England speech by Nick Strange. Before we get started, a few points of immediate note. The regime is still a moving feast. This will become apparent as we go through the presentation.
Sorry, Mark, we just accidentally muted Anita.
Okay, she's unmuted now.
Okay.
Sorry, Anita.
I said the UK regime is still a moving feast. This will become apparent as we go through the presentation, and it applies to financial services firms and FMIs. So by FMIs, I mean financial market infrastructures, clearinghouses, custodians, and recognized payment operators. And then finally, you may want to consider the applicability of the regime's components to non-FS firms. Over to you, Pal.
Okay, so we put the definition as set out by the regulators for operational risk on this slide. And the objective of the regime is basically to build up the resilience of the financial sector as a whole so that it's better able to absorb operational shocks as and when they occur. I think straight away this regime is very different from previous regulatory requirements in that it shifts the industry's focus from firms and FMI's own commercial interests to one that's more informed and driven by the public interest, and it puts the focus very much on firms, clients, and customers. So, rather than the resilience of a firm's systems and resources, it's much more about, how resilient is their delivery of their key business services to their end users. And, so for example, if you have a mortgage business, then the business service is arguably the ability of the customer to buy a house or a flat upon the disbursement of monies from the bank or payment provider. Anita.
Yeah, so the key questions are, what is the business service being provided? And what happens to this service? What happens if there's a disruption to this service for a prolonged period of time? This could range from 2 hours to 2 days, let's say, for instance. It just depends on the business service and the nature of the disruption. And in the definition, while there's a prevention element, it's clearly underpinned by the concepts of a disruption crystallizing and how quickly a firm can recover from the disruption, so as to encourage firms to build out their response and recovery capabilities. So we will return to these concepts of disruption and recovery, but they're very much concerned with what is the impact on end clients. That's retail or wholesale. What is the impact on markets, and what is the impact on financial stability?
Okay, so looking at the timeline, I mean, obviously, it's been the regime has been interrupted by the year of COVID-19. So the regulators issued their consultation papers in December last year, and the deadline for responses on the consultation passed recently in October. So we kind of set out what is our best estimate of the remainder of the timeline, pretty much based on just pushing out what the pre-COVID timeline was, and recent information from the Bank of England. So the consultation period has ended. That means that the policy statement, which will contain sort of pretty much final rules, will be published probably in Q1 next year, and that will trigger a 12-month development phase. So that period will allow firms to start building their operational risk resilience frameworks, or ORFs, and that means establishing what are your important business services, setting impact tolerances, doing the mapping and testing of your framework. At the end of that 12 months, the regulators will publish enforceable rules, and that then triggers a 3-year implementation phase. And what that period is there for is basically to allow firms to sort of make the upgrades, whether that's in terms of people or systems that they've identified and that are necessary to remain within their impact tolerances. And then at the end of that 3 years, in Q1 2025, there'll be a hard requirement to be fully compliant with the new regime.
So, you look at this timeline and you think it's quite generous. Why are we talking about it now? But please keep in mind, this is an estimate. So first thing, that 3-year implementation phase could get truncated. We don't know we're going to have the entire 3 years. And the implementation phase allows the regulators to see how firms are doing, who's at the top and who's at the bottom of the class. You don't want to be at the bottom. And that 1-year development phase is short. You will see as we go through the various components of this regime that it's not a long time. And there will be firms that have already started, but they might get to the implementation phase and start talking to their supervisors and find they have to go back and refine. They just didn't understand the requirements enough sufficiently in the first time round. So, the 3-year implementation phase is a chance to get it right, and refine and revisit. Next slide.
Okay. So the regulators have clearly stated that they're going to be proportionate in how they apply the regime to a wide range of firms, and that means that they're going to take into account the size and complexity of firms. So the burden will be greater on larger systemic firms and on the large financial market infrastructures, so CCPs and exchanges and so on. But nonetheless, in every firm, the board and senior management have to take responsibility and ownership for the design and implementation of their framework. And so there are common elements for everybody. You need to identify your important business services. You need to set impact tolerances. So asking yourself the question, for a given business service, at what point is a disruption intolerable for the end client? identifying and documenting the resources that support those business services. So that's people, processes, technology, facilities, and information. And then taking actions to remain within the impact tolerances that you've identified. And then there's further requirements around communications and self-assessment and the firm's existing capabilities that will also underpin the new framework.
So when you look at just a comment about the important business services, and we'll return to this quite a few times through the presentation, but it's very much focused on identifying the services that, if disrupted, could cause harm to consumers, market integrity, threaten the viability of the organization, or cause instability in the financial system. These are the UK regulators' sort of statutory objectives. Now, that really is a mouthful, right? And it can seem terribly abstract. So we sometimes, to make it tractable, change it to think about it in terms of promises and present it in terms of the language of promises. And that is, what is the intersection of promises a financial services firm, or FMI, makes to its regulator for its license, and the promises it makes to its end clients? This shortcut may or may not be helpful, but we thought we might share. So, COVID-19 has definitely added a dimension for the need for firms to be resilient, but the seeds were sown before then. The UK regulators were already looking at the challenges financial services firms and FMIs were facing around operational activities. These include new technologies, for instance, artificial intelligence, changing behaviors and expectations around instant access, mobile technology, faster payments. And we can see that COVID-19 has only accelerated these changing behaviors and expectations. There's the challenge of keeping pace with change. For a lot of people will recognize within firms, there's been a whole slew of change management programs, one after another. In parallel, you have to manage obsolescence and the skills gaps that comes with this. There's a terribly the environment that firms work within is challenging. Cyber threats are a key concern. They're complex and they're borderless. And then you have the issue, you have system complexity, you have outsourcing. Everybody now is trying to, outsource and use cloud services. So that's an example.
So, you'd think that, COVID-19, some people are saying it's presented almost like an ideal test of operational resilience. And, that's very true in some respects. And recently, the Bank of England highlighted why they think that actually coping with COVID has been a bit easier than perhaps we initially thought. So, what they've said is that it's evolved slowly, so that we saw it coming. We had time to prepare for it. It's been prolonged. Firms have had time to understand and adapt to the changing environment, and it's been symmetric in nature. So it's kind of affected everybody. And, but equally, there are threats that are not slow or prolonged or symmetric, which are the opposite. So they could be fast, short-lived, and asymmetric. And whilst those types of incidents will, rely on some of the same response and recovery capabilities that, firms have developed under COVID-19, those types of challenges will test firms in a way that's very different to COVID-19. So I think what they're signaling is that, don't rest on your laurels if you've had a good a COVID crisis. There are other challenges out there. So it's an ongoing process, and there's a lot for firms to do.
So the cornerstone of this regime, the real cornerstone is the identification of important business services vis-a-vis the UK regulators' statutory objectives. And what we've done here on this slide is put out what those statutory objectives are and looked at them in terms of disruptions to bank services or the services insurers provide. Instead of slavishly going through this slide and these examples, we thought we'd just take a step back and work with an example that we're all sort of familiar with. And that's a retail bank and the customer who relies on it to make payments. So if there's a disruption to the bank services and consumers cannot make payments for a period of time that's intolerable to them, this could undermine the bank's viability or profitability and thereby undermine the PRA's statutory objective to promote safety and soundness. Now, then if you layer on the possibility of contagion effects, or if the retail bank is of a significant size, this could then in turn, this one disruption could turn into something that the Bank of England will be very concerned with from a financial stability perspective. And of course, the Financial Conduct Authority will be concerned about its objectives, and they'll be looking at this disruption in terms of its remit in terms of consumer protection and market integrity.
So, you know, whilst that example is quite illustrative, you know, it doesn't necessarily go into the level of detail that the regulators will require. So, you know, there's a level of granularity and detail that I think as you read the requirements comes out more. So, for example, you know, in that example, we've not considered some of the channels that customers could use to access their accounts or payments, you know, such as the branch, telephone or internet banking. So those are key services that people need to look at as well. And the regulators have stated that they're not going to give out a taxonomy of important business services to different groups of firms or FMIs. They expect firms to come up with their own taxonomy, so that their framework is bespoke to them, and that's what the regulators will judge.
So how should firms approach this new regime? First and foremost, it's an ongoing requirement. It's not a one-off exercise. It's not an annual exercise. Second, the responsibility for developing the framework sits with senior management and the board. And keeping proportionality in mind, firms must identify important business services and design mapping to demonstrate the firm understands how each business service is delivered and the resources required to deliver the important business service. So when we talk about resources, we're talking about people, processes, technologies, facilities, and information. You know, impact tolerances are a key metric that identify the tolerable amount of time a disruption might affect an important business service. When you're outside of that point in time or that amount of time, then it's intolerable. You have to design a testing plan that demonstrates you can respond and recover. You have to develop a communication strategy when a disruption occurs. And you have to design a bespoke self-assessment. The PRA and FCA have said they will not be providing firms with self-assessment templates. So you have to design that even before you start to assess. So building this framework will involve the usual suspects, operations and risk, but you can imagine a number of other departments will be involved, from client services, because they know the clients, to HR, to legal, to IT. So next slide. Okay, so this slide is the biggie, and we'll spend a bit of time on it, just as a warning, but that it's easier going after this. But this is where we go into, we put everything together on one slide and try to present it visually. So first of all, you can see there is a lot to do, and it's easier to look at this in terms of blocks. First, strategic outcomes, including the identification of important business services. And to add to our comments, an important business service is not a business line. They are services to external end users. I can't emphasize that to be enough. They're expected to be viewed as a chain of activities that make them up, from the taking up of an obligation to provide the service to those parts of the chain that are critical to its delivery. Important business services need to be defined at a level of granularity that support the other elements of the framework. And then when it comes to impact tolerances, an impact tolerance isn't an average length of disruption metric or an aggregate metric. It is a metric that quantifies the maximum acceptable duration of a single disruption to an important business service. So I've just seen a comment. So, okay, important business service. So an important business, so an impact tolerance is a duration metric. It's meant to be clear and precise. It can, however, be augmented by other factors, such as number of transactions or consumers. And in fact, in the case of FMIs, this augmentation is expected. Impact tolerances are also expected to focus the mind of boards and senior management to drive improvement. These tolerances are the responsibility of the firm, but there are a few caveats. The regulations governing CCPs and custodians already set 2-hour tolerance levels for critical business functions, which will be counted as important business services for these FMIs. And also the Bank of England and a pilot cyber test tested for an end-of-day tolerance for payment outages. This work is ongoing at the Bank of England.
So then the second element are the supporting requirements, so mapping and testing. And mapping requires firms to understand their business services from end to end, and particularly focusing on those parts that are critical to the delivery of that service. And then identifying the resources that are used in the delivery. So again, people, processes, technology, facilities, and information. And once you've gone through that process, that should identify vulnerabilities. So whether that's, a lack of resources or complexity or concentration risk or single points of failure. And then you have testing, and that testing will include an analysis of the performance of the impact tolerances in severe and plausible disruption scenarios.
And then the third element are the internal capabilities that a firm can draw on to build its framework. These are also likely to be enhanced and upgraded by the firm's work on resilience. I think that's probably clear. These include, but perhaps not limited to, business continuity, operational risk management, and outsourcing and its management. So just a few words on each. Business continuity plans should help a firm recover and will probably help with the mapping exercise. Mapping, remember, looks at resources. From an operational risk perspective, the identification of risk and controls around these resources along the chain of activities that make up an important business service may help a firm understand its vulnerabilities. However, keep in mind that controls already in place may in fact be instigated by other functions, not operational risk. And then in regard to outsourcing, firms are responsible for the processes they've outsourced. So a firm's ability to manage outsourcing is a capability. However, it's only a capability if it's done well. Otherwise, it's not a capability. This will also be true for business continuity and operational risk.
And then cutting across strategic outcomes, supporting requirements and capabilities are two further elements. And that's the fourth element is governance and self-assessment. And ultimately, the board and senior manager are responsible for that. And that includes how firms and FMIs actually document their framework. So that's quite key because that's how regulators find out what you're doing, and they make their assessment initially based on that. So it's documenting how important business services are identified, where, how, and why impact tolerances are set. The basis for any investment decisions that you make, for example, upgrading IT or hiring more people. And then the fifth element is the communications plan. So that's the firm's playbook of what they do when something does go wrong. So for example, if your consumers can't access their bank account because of a disruption, then what communication do you make to them, for example, about, the length of the disruption and what you're doing to fix it. And then all of this together goes to, build improved resilience over time. And, the point is that you're identifying weaknesses and improving them. You're applying, investment, and you're prioritizing investment where it's needed most. And then, what the regulators want is this kind of cycle of continuous improvement, so that your resilience framework is not a one-off exercise, and it doesn't stand still. It's constantly evolving.
Okay, so we're going to skip over much of this slide and the next, because they document much of what we've said in relation to the key elements on the previous slide. But the text is there. But there's a few points we'd like to stress. We've already mentioned the importance of important business services and the issue of granularity. But keep in mind that if a firm is finding it difficult to set an impact tolerance, this may be a sign that they haven't got their business services set at an appropriate level of granularity. In relation to impact tolerances, please keep in mind that impact tolerance is not a risk tolerance. It's not a risk appetite. It assumes, an impact tolerance assumes a disruption is crystallized. And what are the regulatory penalties if an impact is exceeded? We don't know, but it's worth thinking about. In relation to mapping, in my view, it's probably a visual understanding of how an important business service is delivered. It should help to identify vulnerabilities and how they might be addressed, as well as support the design of test scenarios. When it comes to testing, we expect firms will probably initially take a very pragmatic approach and build up their capabilities and start with simple what-if scenarios. But again, it's essential to highlight that firms are expected to improve what they do so they can achieve their impact tolerances. Revising impact tolerances so they can be achieved is not the point of the exercise. Some firms might be tempted to do this. And then there's the governance, communications, and self-assessment. It's the last on the list, but it's really important because, as mentioned earlier, this is where supervisory teams start their assessment of a firm's implementation.
And then in relation to a firm's existing capabilities, building your operational resilience framework, it's going to be a multidisciplinary project, and it's going to require a lot of coordination across different areas. And in an ideal world, there is going to be cross-pollination between the operational resilience and the existing capabilities. But it's important that firms don't undermine one framework in favor of another. As the regulators kind of talk more about what their expectations are, and they publish more, firms will understand more what they're required to do. So, for example, in Nick Strange's recent speech, he makes a distinction between operational risk and operational resilience, and also, he questions whether the traditional approaches to BCP are now obsolete in the light of the last year. But also there are other capabilities that need to be considered, and for example, the relationship between operational resilience and the operational continuity and resolution framework. The PRA has recently published an update on operational continuity and resolution, where because they've been thinking about this for a long time, they're kind of lining up different areas so that it does kind of fit more neatly, and there's more reference to operational resilience within the operational continuity and resolution requirements now. So it's important to note that whilst the frameworks are different, there will be overlap, and the boundaries will become clearer over time. So this leads us to the key question of, who actually leads on operational resilience. And the PRA in their consultation paper, they basically said, look, if you've got a senior management function 24, so chief operations function, generally i.e. the COO, then that's where they think it should sit. And that kind of makes sense because in a crisis, who do you turn to coordinate and lead the effort? And in firms that have a COO, it's generally sits with that area. But clearly, other members of the senior management team will also be involved. And anecdotally, we know that firms that don't have a COO function, they've delegated it to other senior management functions. So, for example, the chief risk officer or the chief financial officer in some cases. But whatever firms do, the overall framework needs to be dynamic and well coordinated because and actually the design of it is very important, because if it's not designed properly, it can be rendered pretty useless. So, and there's a lot of data that already exists within firms, so that needs to be brought together and looked at in a slightly different way than perhaps traditional risk disciplines, because I think there's a lot of data where you kind of need to look at what you do right as much as what could go wrong, to decide what your capacity is for certain things.
So, the discussion so far has been quite theoretical. So we thought we'd include a case study. And we took this case study from the FCA's December 2019 consultation paper. So you can go look for it. The problem is it's not all on one page. It's spread through several chapters as they try to illustrate a point. And the drafting leaves much to be desired because it reads like they're still figuring it out. So don't quote me on that, but it does, they're still thinking about it at that stage. So we won't go through it in slavish detail, but there's some important takeaways, I think, here. First, the important business service is identified as telephone banking authentication. That is quite granular. That's quite detailed. People might think that is too detailed, but it might give you an idea of the level of granularity the FCA and PRA and Bank of England might be looking for. And then when you look at how the impact tolerance is set and what the basis of the 12-hour impact tolerance, it's really informed about, the impact on the consumer and the financial loss and the consumer of the client and the proportion of clients affected. So if you were doing this assessment, this is the sort of thing you have to talk about. And then there's the mapping. So the mapping looks at all the resources and identifies an interdependency. It actually says, hey, look, you've got a second important business service out there, and you've got two important business services sharing a common resource. So so they note that interdependency, and that carries forward into the scenario testing, where it's sort of decided that there's challenges that arise from these interdependencies. It also identifies legacy systems issues. And then there's a series, in this case study, there's a series of next steps. And the list is actually quite long. So confirms a challenge. There's a communications plan that has to be developed. There's this question of vulnerable customers and how to prioritize them, how to update legacy systems, and a strategic review to reduce interdependencies. So we've included this just to make all of this a bit more tractable and sort of illustrate a basic minimum at a very basic level, what you might need to include in your self-assessment. Next slide.
So I won't dwell on this slide too much, but this is pretty much how we can help firms implement their resilience framework. So you can look at that at your leisure. But if you've got any questions, or you want to discuss further with us about the operational resilience framework, do feel free to contact us. Our contact details are on the slide, and thank you very much for listening.
Okay, questions? I see 5. I think I see 5 chats. I'm not sure. Mark, you're on mute.
Good, brilliant. Hey, that was really good, guys. Thank you very much. Really informative, really informative. Listen, we'll go straight out to questions. There's a couple on the chat already. So, Sean, are you still there? Give us a wave. And do you want to ask your question, or should I read it?
Yeah, no, just reading that probably isn't clear. I probably pressed send sooner than I meant to. Yeah, I think just to maybe summarize that, every regulation that comes in, and I'm representing the audit contingent here, we always try to see what the business is doing differently. What does it actually change? Everything I read so far suggests all the regulations is asking us to do is, you're already aware of all of these risks. Can you please map them out in a way that's more customer centric, so that you can understand the impact of what you're doing beyond your bank and on your customers? But has there been any indication from the regulator in terms of tangible things that'll change, deliverables or any updated controls and things that they expect us to have? Outside of what we wouldn't expect a traditional BCP plan to have, or that's something we just find out as we go along?
Hal, do you want me to go, or do you want to try?
If you go first, yeah.
Okay, so I'm going to use an analogy I was sharing with everyone earlier on. Okay, so this is my best way of saying it. So, when you think of a woven basket, right? It's a nice crisscross weave. So I think of business continuity, or operation, or what people do, some of these capabilities as like the horizontal part of the weave. And then, but looking at important business services and mapping them across, it goes on the horizontal. And then the result is a woven material that's a basket that you can use as a basket that can actually carry around to deliver whatever you need to deliver. I know it sounds, because I think what the problem is that firms do a lot of things, but they're not joined up. So they're trying to join it up in a customer-centric way and move the shift. So operational risk, right? The focus on operational risk, it's a prudential thing. What's the loss to the bank, potentially, if something goes wrong? How much capital do I have to put aside? This is about what's the impact on the end clients. So it's a different focus. That's why I think of it as being the horizontal to the vertical. I haven't quite figured out that analogy yet, but I'm working on it. I hope that helps.
Thank you, Anita. Pavin, did you want to add anything?
I would say, like where firms are now, they kind of think in terms of risk appetite. And, operational resilience comes into play beyond your risk appetite, in fact, well beyond it. So I think, where firms are focusing maybe in terms of, day-to-day risk management, this kind of pushes them to think, not so much about worst case scenarios, but it's kind of, when things go really badly wrong and they need to they just need to get everybody in who's going to fix it in a room and then get on and do it. So I think it's kind of beyond the day-to-day, but I think what there've been a number of instances over the last few years. So regulators have been thinking about this probably since about 2016, 2017. And, when there was a parliamentary report back in 2018. And if you look through that, that's kind of where a lot of the building blocks are, and they haven't really changed in the last few years. So I think they're fairly set on what they want to do, and this is kind of it's additional, but it's complementary to what already exists. But I think it does involve people slightly changing their mindset from where they are now.
I guess what I wanted to confirm was, is there an increased responsibility for banks that comes off the back of this regulation, similar to SMCR, where, we're not doing anything differently. We're kind of just having a framework by which you can actually allocate responsibility in a better way, rather than a regulation like MiFID. That's what I wanted to know. Is the comparison closer to SMCR or something like MiFID?
Well, we'll see more in the policy statement, but remember, you have to create a framework, and you have to document everything you've done. So you have to do the mapping. You have to document it. You have to do these assessments, that mini case studies. Your own self-assessment is going to have to look a little bit tidier than that and a little bit more in depth for each important business service. And how many are there? There could be quite a few, depending on the firm and the level of granularity. That's a big lift, and it's a very complex lift.
Yeah, and it will be assigned to a senior manager. So, somebody's got to take charge of it, and ultimately will be held responsible for it.
Thank you, Sean. Tina, you have a question. Do you want to?
Yeah, thank you. I think just back to the last point.
Tina, we're losing you on sound.
Yeah.
Maybe having done some COVID work, seeing quite a lot. You lose me. That the regulator has seen, which is why they're responding to this with this way. So I do think it is a change of approach in some institutions, from my experience. But my question was more in the
Tina, I think, can we come back to you?
The framework from the regulator and potential bureaucracy. And have you seen any outcomes?
Tina, I think so. We keep losing you in and out. I'm not sure. Anita, Pavin, did you get any of that?
No.
Okay.
I missed the key bit.
Okay.
What's in the chat.
Let's come back to Tina in a minute. Tina, so your internet was cutting in and out. A quick question from me. How much, in putting the consultation document together, how much learning was taken from the incidents at TSB, if any?
I mean, that was pretty much probably the starting point, and that was the biggest example, I think, at the time. But there were other examples. There were failures at Visa, Barclays, and Lloyd's as well. So I think there was like a whole flurry of things that happened at various banks, and that affected different customers. And obviously, parliamentarians then get interested. And I think what was apparent is that the regulators have been thinking about this, before Parliament even asked the questions. So, as you read through the parliamentary report and look at some of the oral evidence that was given, they kind of know where they were heading before all that happened. So yeah, I mean, I think TSB is probably the biggest example where a tech glitch affected loads of customers. But even recently, at the beginning of the COVID crisis, you had certain payment services providers that had issues, and even though they're smaller, that affected a lot of customers. So it's something the regulators have been thinking about for a long time. Sorry, I've forgotten the original.
That's fine. I think you've answered it. You've answered it. So let's go to Tina's question then, and she's got it in the chat. So the question is, how do we think the regulator will respond to the suggestion of increased bureaucracy, particularly with no framework defined across financial services firms, leading to challenges for comparisons?
I'll take a stab at that. So the consultation period closed, so you can't, your chance to talk about the bureaucracy maybe have fallen away, but I think the answer to that. They'll say, look at, we need you to focus on customers. We need you to focus on end clients. We need all those people in your firm looking at your risk and controls and servicing your clients to speak to each other and get together, you know, and not work in their silos. And we have provided a framework. This is it. You have a banking license, so we think you're competent enough to work with this framework and deliver what you need to deliver to us. That's what they'll say.
And they've given you the time to do it as well. So, you know, it's not like you've got a year to do it. You've got time to do it. And I think, you know, they're never sympathetic to, you know, suggestions about increased bureaucracy, because they see the wider benefit to customers and clients. And I think actually it is when you read it is actually well thought out.
Yeah.
And you know, I think we would say, you know, we've seen at one particular firm where they've kind of tried to do it their own way rather than kind of sticking initially to the framework that the regulators have provided, and they've kind of come unstuck a bit. So I think, you know, the regulators will say, look, we've kind of told you what we're focusing on, and it's for you to go away and do it, and, you know, tell us what you do, or, you know, and how you're going to improve it.
Brilliant. Tina, does that make sense? I don't know
if you can hear. I mean, it makes perfect sense. I just think the industry common.
Tina, sorry, we're losing you again.
Okay, I don't know what's happening. I'll put it on the chat.
No worries. One other question from me. How ready are the industry? What's the state of readiness?
So I had an interaction with one particular firm, and it sort of stuck in my mind. And some of the things we've said sort of was informed from that experience. So this firm had been working on this already, right? And they should be proud of themselves, but they didn't understand the framework. I think maybe they read the consultation documents once. You know, there were 5 in total, right? There were 5 in total that were issued in December, or they only read 1 or part of 1. And it was clear to me. So the first thing they did was they defined only 10 important business services. And when you looked at, they renamed them. They renamed them as something else, because that's what worked internally. But as a consequence of renaming them, what an important business service is or should be got lost in translation. And then they said, well, we can't do our impact tolerances. We're really having a hard time defining our impact tolerances. But it was clear that they had actually, their important business services were business lines. And you can't come up with an impact tolerance for a business line. You've got to go down and look at the services in those business lines. So there are some firms that have started early, but they're struggling.
Yeah, and I think we've seen a large UK retail bank. I mean, they seem to be well ahead of the curve, and they've kind of organised themselves very much in line with the consultation papers. So, you know, they're sort of hiring in people to identify business services and set impact tolerances, to look at data and IT, but then also to do, you know, the scenario testing piece as well. So, you know, it's varied. I mean, I think the larger firms are probably on it, as you would expect, more than smaller firms. But, you know, it will come to everybody in due course.
I'm conscious of the time. We've got about 5 or 6 minutes left. Are there any other questions? Tanya, Mihaela, any thoughts?
I don't have a question, but I thought I'll contribute with something. Sorry if this was said before, because I missed the first 10 minutes, but I attended a conference where Orlando Fernandez from the PRA Bank of England, he represented the consultation paper for PRA on outsourcing. And I basically asked when they expect for these policies to come out. It was mentioned, you know, how the regulator, they don't actually give a clear indication, but it was said to be expected at the beginning of next year with the implementation shortly after. So in the first part of the year, and together the outsourcing and operation resilience policies, they are expected to come out together.
Yeah. So we had the timeline slide. I don't know if you missed that part.
Yeah, because I didn't join the first.
Yeah, no, but yes, we in the timeline slide we talk about Q1 of next year. So we hedged our bets because you just don't know what's going to happen in terms of their timeline internally with lockdowns, etc. But yes, so then that kicks off the 12-month period,
Yeah.
12-month period, and then the 3-year period. So you know.
Yeah, exactly. And then it's not just like operational resilience, it's also outsourcing that lots of companies, they struggle with. Outsourcing and third-party risk management frameworks. So it's going to be a lot of work in this space for next year.
You know, I'm so happy you brought up outsourcing, because that goes to my point. You know, outsourcing is only an internal capability you can draw upon for this if you do it well.
Yes, yeah. Correctly. And I don't know about you, but probably you came across situations where bigger companies, they do not consider intra-group as outsourcing. So for example, intra-group outsourcing is if it's done within another legal entity, they do not consider that as outsourcing, even if it's clearly falls within outsourcing framework.
Yeah.
Brilliant. Mihaela, thank you for this question. Okay, I'm going to, unless there's anybody else that wants to comment, ask questions, I'm going to say to Anita and Palvinder, thank you. Really informative. I've learned a huge amount tonight. Laura's got a little clappy hand going on there. Thank you, Laura, as has a few others. So thank you. That was absolutely brilliant. If anybody feels they need to know more, want to reach out to Palvinder and Anita, have got challenges themselves that they need help and advice on, then their contact details, am I right, Katie, are on the website?
Yep. On
the event.
Yep.
And if you want to have a replay of this event, a recording should be up on the blog within the next day or two. Hopefully tomorrow morning, Kate. if I get it done.
Thank you.
So it just leaves me to say thank you to everybody. Have a lovely night. I'll see some of you and maybe all of you on our coffee break tomorrow at 12, where we'll be talking about opportunities in the investment trust space for becoming non-exec directors. So come and join us for that if you can. And it just leaves me to say, well, so long, farewell, good night.
And thank you for having us. Thank you.
Thank you.
Thank you.
Thanks.
Cheers.
Bye.
Bye. Bye.